Beyond Financial, we don't chase hype. We test for strength. We take companies, we put them under some serious pressure, and we find the cracks before they turn into catastrophic failures. Our whole mission is to help you forge a stronger portfolio by cutting right through the market weakness. And today, man, we are running a full structural integrity test on a name that was, not too long ago, supposed to be the bedrock of the entire plant-based revolution, Beyond Meat. This thing was a Wall Street phenomenon. I mean, it was a cultural icon. You couldn't get away from it. Now, it's a penny stock. It's got a Nasdaq delisting notice practically nailed to its front door. This isn't just a fallen angel story, folks. This is a potential real-time case study in corporate collapse. So the big question for our analysis today, it's simple and it's severe. Is there any solid foundation left here to build on? Or is this entire structure about to crumble into dust? So to get our answer, we're going to run a 5-stage structural integrity test. It's thorough. First, we'll look at the most obvious crack on the surface, that delayed earnings report. Then we're going to stress test the financials. These are the load-bearing walls of any company. After that, we're going to probe for deeper internal flaws, kind of check the wiring. Then we'll analyze the market's absolutely wild high-stakes gamble on the company's future. And finally, we will deliver our verdict. Is this a deep value opportunity, or is it a classic value trap? Let's get started.
Okay, our inspection starts with the most visible problem. When a company can't get its own numbers out on time, it's like an inspector showing up to a building and immediately finding this long, jagged crack running right up the facade. It screams at you. It tells you that whatever you're seeing on the surface, it's probably just a symptom of a much, much deeper problem on the inside. It's a massive red flag, and it tells us we need to dig deeper and we need to do it fast.
Whoa, hold on a second. A delay happens, right? I mean, sometimes there's just a mountain of paperwork. Auditors need more time, stuff happens. Is this really a 5-alarm fire? Are we talking about a simple paperwork problem here, or is this a sign the financial engine is about to completely seize up? And that is the crucial point. This isn't just one thing. It's not an isolated event. This timeline tells the real story. So look, on March 16th, they get a delisting warning from Nasdaq. That's basically the market's version of an eviction notice. You're about to get kicked out of the club. On the very same day, they delay their annual report. And they specifically point to problems with how they count their inventory. Think about that. Then, just 9 days later, they push the earnings call again. See, this isn't a procedural hiccup. This is a pattern of escalating distress. One problem is an issue. 3 problems in a row, this fast? That's a crisis in the making, and it points directly to chaos behind the scenes.
The cracks on the facade are crystal clear, so now we move to the core structure. It's time to run the numbers and see if this company's financial walls can actually bear any weight at all. Sales. Sales are the foundation of any business. Without a solid revenue base, everything else, all the grand plans, it's totally irrelevant. Let's see if customer demand is holding this company up or if it's dragging it down.
So, the market is bracing for a truly brutal report. Analysts expect revenue to have fallen by over 18% compared to the same quarter last year. Let's be really clear about what that means. For every 5 customers they had a year ago, one of them has just vanished. Poof, gone. This is not a slowdown, this is a significant contraction. It points to a severe, ongoing weakness in consumer demand. People are literally walking away from the product.
But wait, the bad news doesn't stop there. Not even close. The company itself put out its own preliminary guidance of around $61 million. Now get this, that number came in below Wall Street's already pessimistic, already downbeat forecast. When a company pre-announces numbers that are even lower than the bearish consensus, that is a massive flashing red flag. It's telling you the sales decline isn't just happening, it's accelerating faster than anyone, even the pessimists, thought possible.
And if you zoom out and look at the full-year forecast, it shows this isn't just one bad quarter. It is a systemic problem. The company expects its full-year revenue to be down around 10%. What we're looking at here is a sustained, year-long erosion of their core business. The revenue foundation isn't just cracked, it's actively shrinking. It's crumbling, unable to support the company's existing structure. Okay, the numbers look absolutely terrible, I get it. But let's apply some pressure here. Let's be fair. We know shoppers are watching every penny. They're pulling back everywhere. The entire perishable food space, the alternative food space, it's getting hammered. So isn't it possible that Beyond Meat is just a victim here? Are they just a ship being tossed around in a hurricane that's hitting the entire fleet? Or is their ship uniquely unseaworthy?
That's an excellent question, and this table right here gives us the answer. And yeah, you're right, the sector is incredibly weak. Just look at Mission Produce and Calavo. They're both in that perishable food space. They both saw massive year-over-year revenue declines, really similar to what's expected from Beyond Meat. But here's the crucial difference. They both managed to beat Wall Street's super low expectations. They cleared a very, very low bar. And what was their reward for that? Their stocks still got crushed, falling 8% and 5% respectively. In this market, there is zero tolerance for weakness. This sets an impossibly high bar for Beyond Meat. For a company that has already signaled it's going to miss expectations, the potential for a catastrophic market reaction is dangerously high. They are sailing directly into the storm with no holes in the hull.
Okay, so the financial walls are crumbling. We've established that. But a real structural analysis has to go deeper. We need to check the building's internal systems, the governance, the controls, the wiring in the walls. This is where we look for the hidden rot, the kind of stuff that can bring the whole structure down from the inside out. And let me tell you, a company that can't trust its own numbers is a company flying blind, and the market knows it.
Before we go any further, we have to define a really critical term, material weakness. Now, this isn't just some boring accounting jargon. It is a formal, public declaration that a company's internal controls are broken. Think of it like this. The company is admitting that the scale they use to weigh their own inventory might be busted. They can't be sure their numbers are accurate. It's a public admission of incompetence in their most basic, fundamental function, counting their own stuff.
Okay, let me just translate this from corporate speak into plain English. They're telling the world, officially, that their process for counting their inventory is fundamentally broken. So they don't even know for sure what they have in the freezer or how much it's actually worth. This is way bigger than a reporting delay. This is about not being able to trust their own books. I mean, how can an investor possibly make a decision if the company itself is admitting its data is unreliable?
Exactly. And it gets worse, because the problem is retroactive. The company admitted it found errors in its past financial statements for the first 3 quarters of the year. Specifically, they understated their costs and they overstated an impairment loss. Now, they claim the errors are immaterial, but the fact remains, they've been reporting incorrect numbers to the public all year long. This just completely erodes any remaining investor confidence. It suggests a systemic breakdown in financial oversight. It's a mess.
So when you take all these toxic ingredients and you mix them together, you get a perfect storm of risk. You've got the existential threat of being delisted from the Nasdaq, which is a corporate death sentence for many. You've got a total lack of financial transparency because of the delays and these material weaknesses. You've got cash flow just being torched by inventory markdowns because the product isn't selling. And underpinning all of it is absolutely no clear, credible path to ever making a profit. Each one of these is a major structural flaw. Put them together and they threaten to bring down the entire building. We've established the internal structure is profoundly unsound. Governance is flawed. Demand is collapsing. So how does this translate to the market? This is where it gets really fascinating. Traders aren't just pricing in a bad quarter. Oh no. They are positioning for a fundamental binary event, a complete reset of the company's value, one way or the other. It's all or nothing. This number right here says it all. The options market, the smart money, the professional gamblers, is pricing in a 32% move in the stock, up or down, after the earnings are released. Now, to put that into perspective for you, a typical post-earnings move for most stocks is, in the 7 to 10% range? 32% is an explosive, almost unheard of level of implied volatility. This is not a bet on whether they beat or miss by a few pennies. This is a bet on survival versus total collapse. So what does a 32% implied move actually mean for an investor on the sidelines? It sounds like you're either going to lose a third of your money overnight or you're going to make a third. Is it really just a coin flip at this point? What could possibly happen to justify either one of those extreme outcomes? Well, it means the market sees 2 possible futures and absolutely nothing in between. The binary bet is laid out right here. The bull case, the only scenario for a 32% pop, is that management comes out with a shocking, credible, detailed plan for profitability and provides hard evidence that the sales decline has finally bottomed out. The bear case, the one that leads to a 32% collapse, is that the sales decline is even worse than we feared, guidance for the future is abysmal, and the stock suffers a complete technical breakdown, triggering a cascade of selling. The market is screaming there is no middle ground, it's either a miracle turnaround or it's a final trip to the slaughterhouse. And this brings us to the end of our structural integrity test. We've examined the evidence from every single angle, from the service level cracks in their reporting timeline to the deep foundational rot in their internal controls and the seismic bets being placed by the market. Now it's time to assemble all the findings and deliver a final verdict.
You know, it's almost hard to remember, but this brand was once a titan. It had a powerful public image, a truly revolutionary product, and a story that just captured the imagination of Wall Street and consumers alike. But as we've seen today, that pristine public image now masks a state of intense internal turmoil. And this isn't just about one company either. Beyond Meat was the poster child for the entire plant-based movement. Its collapse sends a powerful and frankly chilling signal about the viability of the whole category when it's faced with real economic pressure and growing consumer skepticism. So our test revealed three critical, undeniable failures. First, the governance is flawed. The admission of material weaknesses means the company's own data cannot be trusted. The foundation itself is unreliable. Second, weakening demand. The numbers don't lie. A sustained double-digit revenue decline is proof positive that their customer base is shrinking, and fast. The load-bearing walls are failing. And third, you have existential threats. Trading as a sub-dollar penny stock with a delisting notice isn't just bad optics. It threatens the company's ability to operate and access capital. The entire structure is at risk of being condemned.
And this brings us to the ultimate question for any investor looking at a beaten-down stock like this. We know it's cheap. It's trading for pennies. That temptation to buy what looks like a bargain is so powerful. But our analysis has shown the foundation is fundamentally cracked. The data is questionable, and the core business is actively shrinking. So the real question you have to ask yourself is this. Is there any price that can possibly compensate you for the risk of a total 100% collapse? Is it ever worth trying to build on a foundation this compromised?
And that brings us to our final verdict. Based on this structural integrity test, Beyond Meat is a trap, not an opportunity. Some might be tempted to try and catch this falling knife, hoping against hope to find a bottom. But the evidence, all of it, points to a company with deep systemic flaws in its governance, its operations, and its market position. Here at Iron Financial, we build portfolios on solid ground. This company isn't solid ground. It's a sinkhole. The risk of total collapse is just too high. Avoid it.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.